My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. If you want to make friends, I'm just trying to help you save some money. My job is not just to entertain, but to educate and teach and put this one in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After another brutal day in an increasingly shaky market, Dow plunging 390 points, S&P plummeting 1.22%, NASDAQ nosediving 1.20%. I know they're bad, but believe me, it was worse at one point. Everybody on Wall Street is searching for companies that are strong enough to transcend the day-to-day havoc. And there's a lot of havoc to transcend. This morning, we opened down hard on fears that the Chinese government might need to crack down on the extremely heated protests in Hong Kong. Hey, listen, maybe they'll even go full Tiananmen Square, send in the army, the PLA, to cool the situation down. But then buyers stepped in to take advantage of the pullback. The averages bounced nicely. After all, so far, China hasn't done anything serious, and there was nothing else driving us down other than a negative note by Goldman Sachs about a possible slowdown in the economy. But then those buyers who came in, they got blasted. Next thing you know, bonds are taking off again, interest rates are falling hard, and we get hit with an all-too-familiar freakout. Everyone's worried that something must be very wrong in the global economy if rates keep falling like this. Doesn't matter that lower rates actually do spur commerce. It's too unnerving to see the benchmark 10-year Treasury sporting a 1.64% yield and going down so much in yield so quickly. Whew, that is pretty incredible, isn't it? Wow. So why do investors from all over the world keep crowding into safe assets like U.S. Treasuries and crowing that it's great to get out of the stock market? Okay, first, there's a sense of foreboding caused by the trade war. The vast majority of economists will tell you that tariffs are the bane of growth. I think we need to crack down on China's bad behavior, but there's some truth to that argument about tariffs. The trade war is starting to hurt Chinese consumer spending, that is for certain, and Chinese capital spending. The Goldman note this morning that I just referenced argues that it's only a matter of time before the slowdown gets exported to our shores. Second, central banks worldwide are indeed engaged in a race to the bottom. You hear that a lot, right? They're doing everything they can to debase their currencies, lower interest rates in order to breathe new life into their economies. Makes sense. Unfortunately, that means they're devaluing versus our greenback, which makes the dollar less competitive and therefore our companies less competitive. This makes people afraid because central banks wouldn't be doing this, right? Unless they were worried about the global economy. I mean, why bother? They must know something we don't. Keep hearing that. The upside here is that lower rates are indeed good for business. But nobody on Wall Street seems to care right now. They don't think lower rates will spur commerce, something I haven't heard since the Great Recession. To me, this is crazy. The current situation is nothing like the lead up to the Great Recession. We're practically at full employment. Lower rates should be fabulous for business. However, so many money managers are just totally terrified by the implications here. The idea that rates would never be this low unless something was very wrong. That they don't care about the positives. They're not looking for opportunity. We always look for opportunity. Third, a lot of people are concerned about negative interest rates, particularly in Europe. But there's nothing inherently wrong with negative rates. Unfortunately, the places that have them are so risk-averse and wedded to austerity that they won't take advantage of them to be able to issue debt, get their economies moving. Now, these governments could borrow money at a negative rate. People would literally pay them to take the money, but they won't do it. The problem? Well, most of the people who run Europe live in fear of inflation because of what happened in the Weimar Republic when there was hyperinflation. Even though the problem right now is obviously deflation, they still haven't gotten over that Weimar era of hyperinflation. Plus, the European Union has rules against deficit spending that make it harder for members to borrow massive sums of money, but they could do something. Of course, that doesn't explain why our government refuses to take advantage of the situation to refinance the nation's balance sheet. If only they could do that. Not allowed to do it, but they could make an exception somehow. We could borrow a fortune for 30 years at barely more than 2%. Now, this, to me, is a failure of imagination by our government. People are desperate to buy U.S. Treasuries. The government should give us them, at least to support infrastructure spend. Final reason, there's so much doom and gloom that even businesses aren't borrowing like they used to. I think that's the main worry here right now. Companies won't be able to expand because something is wrong with the economy. The bears think this fear will eventually trickle down to the consumer in a very negative way. The idea here is that we could basically talk ourselves into a recession, even though the only thing to fear, thank you, FDR, is fear itself. Now, I know this all sounds like circular reasoning, but it's happened before. The economy is all about confidence. And when you lose that confidence for whatever reason, it can do a lot of damage. So people are talking about this like it's a totally binary fixation. We're either in the roaring 20s, right, or we're roaring like the 20s, or we're crashing like the 30s. I think it's more likely that we'll have incremental deterioration. Things were going very well. Now they're going to go a little worse. I don't think it's worse than that. But that brings us back to the big question. What can transcend all these woes? What kind of stock can you buy? I mean, there's always a bull market somewhere, right? What can make you money, or at least make owning stocks feel less painful in this environment? Well, first, I've got a list here. Oh, there's nothing new. You need gold. When rates are extremely low, owning a non-interest-bearing asset like gold is a very smart way to put your money to work. I want you to think of it as insurance against economic chaos. You can own the physical metal, never mind at that. You put it in a safety deposit, do not keep it at home. An ETF that mirrors gold prices like the GLD. At the same time, you know what? I got two miners I like. Barrick Gold, which just merged with Rand Gold, kept the symbol GOLD, and I think it represents great value. That's Dr. Mark Bristow, okay? And then this morning, Sean Boyd's Agnico Eagle. This morning, Barrick reported a great number, and then I like this Agnico Eagle. We had Sean Boyd on recently. Wow, he's got terrific growth. Hey, you know what? Let's just do this. Either Barrick or Agnico Eagle's fine with me, okay? They're both run by talented executives. Second, how about some safe dividend stocks with rates so low? When rates go down, investors put a premium on anything that gives you a safe, consistent yield. Now, the obvious ones are the utilities, American Electric Power, Dominion, Con Ed. They're the three that I've been using. When I say using, it means that I've talked to you about. I like it. I like some of these real estate investment trusts. I like Ventas. That's Deb Cafaro. How great has she been? Telco, it's Verizon. Just reported a pretty good quarter. Third, there are the classic slowdown stocks, a little more riskier. That's why Campbell Soup, Kellogg, Coca-Cola they all held in there today. You know what? I do like Merck. I like Bristol Myers. It's down a lot, but they're doing some good things. These companies are either consistent like Coke and Merck, or they're taking action to re-accelerate their growth like Campbell Soup and Bristol Myers. Wow, look at that Merck, huh? People know quality when they need it. Fourth, you can hide in the stocks of retailers with enormous scale. Now, this is something that is my view. Others don't agree with me. I don't care. I like you to be in WATCH. That's my acronym for Walmart, Amazon, Target, Costco, and Home Depot. Some people believe these companies could be used losers in the trade war. I think that's nonsense. The WATCH names are winners in this environment. Consistent winners, because they can strong-arm their suppliers into eating the cost of the tariffs. And they have such a hold on the American consumer. Now, while I think the recession stocks work here, I do not believe that we are headed into a recession, people. There's too much going right. Lower mortgage rates, lower car rate loan to buy cars, robust consumer spending, very strong job creation. Yes, there are weak spots, but that's hardly the stuff of recession. However, because of this job, I'm also a student of the market. And the bottom line is that as a student of the market, I know you can't fight this bearishness short term. Over a longer time frame, I think I'll be proven right about the economy. But for now, the day-to-day action is going to favor the slowdown stocks and wreak havoc for the industrials, the technology stocks, and worst of all, the financials, until rates get so low that sellers at last come into the market and buyers come back to stocks. Of course, it will be done at the exact same time. Let's go to Andrew in Missouri. Andrew.
Booyah, Jim.
Booyah.
Big fan of the show.
Oh, thank you so much.
You betcha. Yeah, you've been really helpful. I've been in about 3 years learning, and it's helped me a bunch.
You're terrific.
But hey, I've raised some cash levels in the IRA, so I just wanted to see. I've been looking at really beat-up names here lately, and I was thinking maybe Kraft Times is about time to take a look.
Well, look, I spent a lot of time over the weekend looking at Kraft Times. It happens to be, like an hour. Maybe I should spend even more, but the truth is that they're doing quite badly. And I can't recommend a stock just because it's cheap, because it turns out to be often not cheap when we see the earnings. So I'm going to have to say no to that. I prefer Coca-Cola. Let's go to Jerry in Kansas, please. Jerry.
Yes, Mr. Cramer. I bought some Canada Goose at $20 a share, and I sold some of it at $70 a share. Ooh. With everything that's going on, should I sell the rest or keep it?
I think that people, I'd sell some. I'd sell some because I think that in the end, the apparel stocks are losers right here, and even the good ones are losers. So, even the VF Corps, and I think that's such a good situation. I don't want to touch apparel. Let's go to Casey in California. Casey.
Hey, Jim. This is Casey from South Sacramento.
I love Sacramento. Sacto.
The stock I'm calling about is Shopify. Is it too late to jump in, or does it still have room to run?
No, you got to wait for it to come down. I mean, it hit 372 today. It is a big action alerts name. I've got a very big conference call Wednesday where I want to talk about the Shopifys of the world and why I thought it was okay to do some trimming because, wow, some of these stocks went up so far, so fast. Let's go to Chris, where my daughter used to live, Oregon. Chris.
Booyah to you, Jim, from the scenic Pacific Northwest.
Well, I love that. I love where you live. What's
Dunkin'.
up?
I'm looking at Dunkin'. Been collecting it since the beginning of the year, and with their Beyond Meat partnership, was wondering what you're thinking for the rest of the year.
I like that sausage, but you know what? That's not going to move the needle. That said, Dunkin' is good. I like Starbucks more, but Dunkin' is a very good story, and I certainly am not going to tell you that it's anything other than a very good stock, though. All right, there is a lot of terror in the street. But there are stocks and themes that can buck the gloom and doom, and you can go into them very slowly. This one, you have a little more pressure to get in right now. All right, that's the key to remember, especially on days like today. I don't want you to be ruled by fear. Well, Mad Money tonight, Trump slammed video games for violence this week, but Take-Two Interactive was still able to beat its earnings outlook. I'm talking with the CEO about all of its headlines. Then it's not a doctor, but it plays one on Wall Street. I'm talking to the CEO of Keurig Dr. Pepper to see if the company could be worth owning in the current environment. And it's a company that put a wrinkle in Botox's plan to dominate the market. Don't miss my exclusive with Evolus. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.